We have 5 Canadian stocks that are not only blue chip, but they are stocks you may never want to sell. Hold on to your seatbelts, folks. This is going to be a good one. There is a style of investing that is often thought of as a circling the wagons approach to your long-term strategy. Circling the wagons is a term that goes way back to the very olden days when new settlers, if attacked by wild animals or maybe some native folk, would put their wagons in a defensive circle to maximize their chances of coming out better on the other side. With investing, this is a risk management approach that came about by studying the most successful investors. With a very successful investor like, well, Warren Buffett, for example, they tend to have a few stocks that they never sell, as these stocks are good enough to carry the entire portfolio. In fact, these are the stocks that will make up for all of the losers we're going to pick over the lifetime of our portfolios. The losers will, in most cases, outnumber the winners quite significantly. These never sell stocks become the wagons that protect our portfolios. The key with this strategy is to buy these stocks and never sell them. In fact, you're not going to take profits from them at all. They are the exception to the "it is always okay to take profits" rule. These are stocks you simply don't want to touch unless you're adding to them. These stocks, they tend to be blue chip stocks with deeper pockets and a 10-year history that graphs out to match the uphill trek our parents used to walk to school in the snow. These are undeniable winners with the history to prove it. And I gotta say, we all love a winner. Join the conversation. Let us know in the comments if you have any hold forever stocks. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a big thank you for that click. Knowing that you guys really love your dividends, I did ensure that all of today's companies have at least some amount of dividends. That did eliminate some great growth companies like, well, Constellation Software, for example. I also ranked them within the list by their return on equity, which is a statistic I absolutely love. So let's get those wagons in a circle and jump right into today's list. Kicking off this list, we have Fortis with a ticker of FTS. This is a massive utility company based out of Newfoundland, but with a strong presence in all of North America. They are well managed and they have a strong renewables game plan, setting themselves up for future success. When we look at their data, their market cap comes in at $26.53 billion. They have a very stable beta of 0.19. Their earnings per share comes in at 2.25, and they have a price to earnings ratio of 17.80. That return on equity, that comes in at 7.54%. When it comes to debt, their debt to equity ratio comes in at 125.9%. This is one of those ones that has a nice looking yield of 7.54%. That is paid out quarterly in the amount of 56.5 cents per share, and they have a payout ratio on that of 75.34%. Looking at their returns, on the 3-year, their return on investment comes in at 2.33% for a total return after we add in the dividends of 14.21%. On the 1-year, a little bit more of a struggle, but that return on investment comes in at negative 10.11%. Total return after we add in those dividends of negative 6.43%. And in 2023, we got a little bit of a recovery going on. The return on investment comes in at negative 0.13%. Adding in the dividends, we get a total return of 1.94%. They had a wee bit of a struggle as energy slumped last year, but this is a company with a strong track record of long-term growth, as we can see in their 10-year chart. In our next spot, we have BCE Incorporated with a ticker of BCE. They are based out of Verdun, Quebec, and they are one of Canada's big 3 telecommunication companies. They have a market cap of $51.79 billion, another pretty stable beta of 0.46. Their earnings per share come in at 2.52, and they have a price to earnings ratio of 12. Their return on equity comes in at a nice looking 11.16%, and their debt to equity ratio comes in at 160.16%. When we look at their dividends, their dividend yield comes in at 6.816%. That is paid out quarterly in the amount of 96.8 cents per share, with a payout ratio a little on the high side of 149.80%. That is a unsustainable payout ratio, but I do feel like that will improve as that sector begins to recover. When we look at their 3-year return on investment, that comes in at negative 1.34%. Adding in the dividends, we get a total return of 17.40%. On the 1-year, their ROI comes in at negative 12.39%. Adding in the dividends, we get a total return of negative 6.56%. Looking at this year, the return on investment comes in at negative 5.05%. Total return with those dividends comes in at negative 0.27%. The big 3 did suffer in the recent bear market, and recovery is still a work in progress. However, when we do look at their 10-year, we can see that this is a company that will bounce back and will be worth the long haul. Coming in at number 3, we have Toronto Dominion Bank with a ticker of TD. They are based out of Toronto and are one of the bigger of Canada's big 6 banks. They have a nice looking market cap of $158.36 billion with a beta of 0.89. They are just a little bit less volatile than the market. Their earnings per share comes in at 7.92 and they have a price to earnings ratio of 10.70. Their return on equity, that comes in at 13.75%, and their debt to equity ratio a little on the high side at 332.2%. But keep in mind, a higher debt to equity is absolutely normal with a bank. When we look at their dividends, they have a yield of 4.452%. That is paid out quarterly in the amount of 96 cents per share with a payout ratio of 46.72%. Looking at their returns for their 3-year return on investment, that comes in at 38.02%. Adding in the dividends, we get 54.64%. When we switch to their 1-year return on investment, that comes in at negative 1.08%, total return of 3.25%. Looking at 2023, their return on investment comes in at negative 2.73%, and factoring in the dividends, we do get a total return of 0.52%. Their 3-year absolutely looks great, but we can see the trouble in the banking sector creeping into the more recent values. When we zoom back out to their 10-year, though, you can kind of see why they are on this list. Taking our almost top spot at number 2, we have Canadian Natural Resources with a ticker of CNQ. Based out of Calgary, they are a Canadian oil and natural gas company that focuses mostly on Western Canada, though they also do a little bit of work out of the North Sea and Africa. Their market cap, that comes in at $90.90 billion, and their beta comes in at 2.00, making them twice as volatile as the market average. Their earnings per share comes in at 6.91, and they have a price to earnings ratio of 12. When we look at their return on equity, that comes in at 19.48%, and they've got a really nice debt to equity ratio coming in at just 35%. When we look at their dividends, they have a yield of 4.326%. That is paid out quarterly in the amount of 90 cents per share. Their payout ratio comes in at 49.78%. Looking at their return on investment for the 3-year, they brought in 223.81%. Add in the dividends, we get a total return of 253.96%. Holy banana bread, that's not too bad. When we look at their 1-year return on investment, it comes in at 16.16% for a total return after we add in the dividends of 20.91%. For 2023, their return on investment comes in at 11.55%, and we get a total return after adding in some of those dividends at 15.11%. You simply can't argue with these returns, and to top it all off, they have a very nice looking 10-year chart that shows a lot of promise. Also, considering the slump in the energy sector didn't impact them as much as some other big sector companies, that's a plus for their future viability. In our top spot at number 1, we have the Canadian National Railway with a ticker of CNR. They are based out of Montreal, and they are Canada's largest railroad, and they're a very integral part of the supply chain. Their market cap comes in at $104.40 billion, and they have a less volatile than the market average beta of 0.68. Their earnings per share come in at 7.98. They have a price to earnings ratio at 19.30, and their return on equity, well, that comes in at 24.97%. Their debt to equity ratio comes in at a nice looking 85.05%. When we look at their dividends, they have a yield of 2.01%. That is paid out quarterly in the amount of 79 cents per share. They have a payout ratio of 39.09%, making that payment incredibly sustainable. When we look at their return on investment, their 3-year ROI comes in at 12.45%. Add in those dividends and we get 18.26% as your total return. On the 1-year, their return on investment comes in at negative 4.20%. Adding in dividends, we do get a total return of negative 2.35%. In 2023, their return on investment so far this year is negative 2.93%. Factor in some dividends, we get a total return of negative 1.95%. These statistics may not be as good as number 2's, but this is a company with a great 10-year look, and they are as recession-proof as they come. In addition to that, they are also a key part of the supply chain, and that makes them as blue chip as they come. These are some awesome stocks that really do make a great foundation for your portfolio. These are the stocks that when they are down, you celebrate and buy more after doing your due diligence, of course. In some future videos, we will absolutely expand upon this idea, and as we do that 0 to 100K TFSA challenge, you're going to see this factor in as we go along. This is absolutely going to be very exciting. Coming in at number 3, we have Toronto. Keep the learning going. Watch my video on the 0 to 100K TFSA challenge, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.